The second type of publication question is when you are supposed to do your P&L from top to down, meaning you are starting with revenue to get your own profit. Then you do your balance sheet. Now, in those types of questions, you start, I think I didn't do the statement of changes in owner's equity for the second question, right? We didn't do that. The examiner requested for that. So let me show you how that works. Good news is that since you've been able to do your balance sheet and it has balance, you use this part to do your statement of changes in equity. You use this part. That's the good news. Now, so what do? You set it up. Statement of changes in equity. So you say things. Statement of changes in owner's equity. That one too is asset. So, or you can also use for the year ended, like the way they've said it here. For the year ended. December 2015. And your headings are the things in your equity side. So you start with equity capital. So equity shares. From there, what did you have? You had share premium, retained earnings, and revaluation. Share premium. Retained earnings. Revaluation. Then you put total. You put in your currency signs. All right. Then you start with balance brought down. The equity, what was the balance brought down? That is where you need to be a little careful because they did a right issue before they had this balance carried down. This balance carried down. So it means we will have to find that right issue that was done. We need to find that right issue that was done. And I will show you how we do right issue, but I will use another day to teach you IAS 33. The likely standard item. So that is that. But the retained earnings, you have the balance brought down, which is 158, 150. The revaluation, there was no balance. Share premium to what we have there is 5,000. That is what we have. So let's do the right issue. It will help us know what was the equity balance. Now, this is it. They said on 1st September 2015, Fins made a right issue 145 right issue at 1.25. That means that what they are basically saying is that they have some shares there, but they will give you one for every 5 you used to have. So if you have 5, you get 1. So that is what is happening. Now, this is how we do right issue. You will say, this is what you do. You need 5 to be able to have 1. If you don't have 5, you can't have 1, an extra 1. That is the meaning. That's the meaning. Now, the extra 1 they are giving to you, the price of that extra 1 is 1.25. That's the price of that extra 1. But we need to know the share price before this right issue. So What is the share price before? It was 1 Ghana cedis. That is what is here. It means it was 1 Ghana, but that won't make it possible because we need to find something. Now, right issue is giving, this is the meaning. Right issue is giving shares to your existing shareholders at a price below the market price. This one is the nominal price, so it's not a market price. So the right issue price cannot be more than the, what do we call it? The existing price. The right issue should be less than the existing price. So this one can't be. So the examiner should help you to give you the right issue price. Sorry, the share price for that one. Now, so it means that in this case, we need to work it out. Now, watch this. If the total of the shares we don't know, but we know that the right issue plus the shares that are already there is 120. That one we know. We know that the total of the shares becomes, what do you call it? 120. Because that's what we see. And that thing is after they had recorded the right issue. So this is what we can do then. We know that the shares at December, the share value at December is 120,000. If we know this, then we are going to use the right fraction to know. And when we say right fraction, it's a simple thing. All right, or bonus fraction or any those fractions. You see, it means that the total 6 shares gave us this 120. All the 6. The 5 plus the right issue gave us the 6. So if this 6 is 120, then I can find the shares that were there before the right issue. And I can also find the number of shares the right issue brought, the amount it brought in. And how can I do that? It's simple. Very, very simple. Because the total number of shares is 120, and that is what you use this thing to do, this 1 Ghana cedis to do. The total number of shares is 120 shares, meaning that if I take this one and I divide it by 1, I'll get 120,000 shares. That's the total number of shares. So the total number of shares, including the right issue, they are all 120. And with the price of 1, they give 120,000. So if I want the right issue number of shares, all the 6 is 120,000 shares. If I want the right issue, this is the part of the right issue. And if I want what was existing before, this is what was existing before. So I'll just do a fraction. 5 out of 6 of the 120,000 will give me the shares that was there. 1 out of 6 of the 120,000 will give me the right issue. So do that and let's get the difference. Do that. Especially the right issue one. That's the one we are interested in. Can find the right issue, then we know what was existing before.
100,000.
So which one are you giving me? This one?
The first one, yes.
That's 100,000 shares, which the company
Yes.
values at 1 Ghana cedis. That's what they have. Then what is the other one? That's like 20,000, eh?
Yes.
What do you have?
20,000.
It's 20,000.
Yes, please.
20,000. So it means that the right issue brought in 20,000. Now, another thing you must learn, and maybe when we do console, I will show you, is that anytime a company sells a shares, they sell shares above the nominal value. That the thing is 1. They did 1.25. Then it means that the 0.25 part is for share premium. So if you do 0.25 multiply by this, maybe that's what they get the 5,000. Check. note 5 count, no? It means this thing is coming from that note. So you multiply this thing by 1 to get the one that you add to stated capital. You multiply it by 0.5 to also get the one that was taken to share premium. But they told us all these things were done. They told us all these things were done.
Yeah, I had 5,000. The 0.25 by the 20,000.
Yeah, so that means that's where the share premium came from. So it means even the share premium, as at the beginning of the business, they didn't have it. That's why they attached the note on it. So where is the... So it means this one crowd didn't exist. So it means this. So it means from the beginning of the year, this side is 100,000. Then you do a share issue. They did issue of share, the right issue, which brought in 20,000 here and the 5,000 on the share premium. That is it. So this is it. Then the transfer that we did, the one we took from OCI to the so the revaluation surplus, I have not brought it. So let's just put the revaluation surplus somewhere. Revaluation surplus was how much?
140,000.
140,000. And we did deferred tax on it, right?
Yes,
Of 28,000.
Mm.
And we also did a transfer from that. That's why I said do your balance sheet first. You see, everything you are doing is coming from here. So the deferred tax we did 28, and this one, where is it? So this is it. All right. No, this is it. So you've done this. Also we brought this because we had taken away the 28,000 already. So then the transfer of 5,500. At the end of the day, the final answers of your source should be the figures you see here. So if your balance sheet didn't balance, then it means whatever thing you'll be doing is wrong. So here you move it from the OCI and you bring it here, 5,500. Then lastly is the profit you had. Profit for the year, the one you came to add. So you see that your retained earnings, it is this plus this. So the profit you had for the year, that is the only thing left. So profit for the year. And it was 90, what again?
95 and 80.
95 and 80. All right. So when you add everything, it should give you your source balance, your equity side, the balance on your equity side. All right. So that is that. Here is 120. You go and check. Is that what you had in your balance there? Yeah, you will see 5,000. This one too, you go and check. So retained earnings. Retained earnings was 1,258,730. So that is it. All right. 258,730. And this one, what do you have? You have 106,500. And 0.500. The total should be equal to, everything should be equal to the last figure you totaled at your equity side. So that's how you do statement of changes in owner's equity. All right. So that's how you do it. So now let's go and look at this question. Question 3. So in this type of questions, as we saw, we've read before, what you do is to go through it and do your P&L structure down. and also do your balance sheet structure down. So Printco is a manufacturing company that has a trial balance you see. You have equity, you have other components of equity, which is a share premium. You have retained earnings, you have plants, the cost and the accum dip is given. Land at cost, bank loan. So check the notes that are attached. Trade and other receivables, trade and other payables, cash at bank, and it's this one, there is no an overdraft. You have revenue, you have production cost, you have admin, you have distribution, you have finance. All right. So you also have what do you have? Inventory. Good. So something is not there you usually see. They've changed the name. What is that thing? When you are doing P&L, there is something there you usually see, but that thing is not mentioned there. They just changed the name.
Cost of sales.
Cost of sales. Which one do you think is your cost of sales?
The production cost.
Production cost. That is it. That's a good spot. All right. So that is it. So from here, the others should be straightforward. Additional information. So you go through. On January 2012, Printco raised funds of 30 million. The full amount was recorded in a nominal ledger as a bank loan. All right. The funds actually consisted of a bank loan 16 million and 14 from a 7 million ordinary shares. So part of the loan came from the bank. Part of the loan also came from ordinary shares. Now, so 16 came from bank, 14 came from issue of 7 million ordinary shares. When you issue shares and you get money, that money, it doesn't go to loan. Where does it go? When you issue shares to your shareholders, they give you, when shareholders give money to the business, what is it called? Hmm? Class. Money given by the owners of a business into the business. What is the name? Hey, this is serious. If you are owner of a business and you put money into the business, what is it called?
Capital.
Capital
Capital. So
injection.
you should know that that money should go to equity capital. But they told you that the full amount was recorded in the bank loan. So there is an adjustment you need to be doing. That's the idea. Interest payable on the loan is 5% per annum. An accrual of 6 months interest has been included in trade and other payable and recognized as a finance cost. However, the calculation of the interest was incorrectly based on the nominal ledger loan balance. You understand? Because the loan proper that you attract interest is the 16 million, not the 30 million, because ordinary shares don't take interest. No. So it means there's a mistake there you need to work on. Inventory at June 2012 were initially valued as the end of the year, were initially valued at total cost of 7. This includes 700 units of cost of 1,004 per unit. In order to sell this item, they need additional process that costs 400. At which point they can be able to sell at 1,600. So if you know your IAS2, what is the principle? Lower of what?
Cost and net realizable value.
All right, so we will apply that one there. At 30th June 2012, Printco has contract to purchase 22,500 electrical components over the next 3 years at the cost of each 450 each. These purchases were made at the constant rate. These components are no longer required for their initial purpose. but do have alternative uses, which will require additional manufacturing cost of 600 per component. Thereafter, each component can be sold for 900. Alternatively, Printco can cancel the contract after immediately by paying a penalty of 4 million. Any adjustments relating from this information should be made in the administrative expense. Ignore discounting. This is what we call onerous contract. And I will show you how you will deal with it. A contract that when you go into right from the beginning, you know you will make a loss. You call it onerous contract. Now, let me ask you a question. If you enter into a contract, then you realize that, this contract, if I fulfill the contract, I'll make a loss of 10,000. A loss of 10,000. And you don't want to make a loss, so you want to cancel the contract. When you cancel the contract, it will cost you 8,000. Will you cancel the contract or you will not cancel the contract?
I'll cancel the contract.
Yeah, so we use the lower of the penalty and the loss. So we already know in this one that the penalty is 4 million. So we need to calculate the other side. What is the loss that will happen if we continue the contract? Then we will pick the lower and we use it as our provision. All right, this is IAS 37, by the way. And I'm sure I don't know if you were taught under IAS 37. Now, on July 2011, that's the beginning of the year, the directors decided to sell a piece of land of an asset, a piece of machinery, and the asset met the criteria classified as held for sale. The machine, which cost 2.4, had a carrying amount of 1.5 as of July 2011. At that date, its fair value less cost to sell was 1.14. The machine was sold for 1.1 after selling cost on 1st July 2012. No adjustment has been made. What standard is this one? It's even there. Classified held for sale. It's NCA held for sale.
IFRS 5.
I hope you have done that one too. What is the measurement criteria? What's the measurement criteria for IFRS 5? You know, I will let you join the CR people's intervention when we are learning the standards. I have a particular day for standards only.
Okay, please.
It's the lower of the carrying amount and fair value less cost to sell. So watch out. But Hetty, you have done that one, haven't you?
Yes, I have done it, but I'm still recapping. So
Okay. Now, Printco has a policy to depreciate machinery 15% and to present the depreciation charge in the cost of sales. The tax income or the income tax refund estimated for the year is 2.53. This is a refund. This is not a liability. Take note of that. You have to prepare P&L. And so this is what we do in this type of question. Your page 1, you will set up your P&L. Even without reading the question, you should be able to set up a P&L. Page 2, you set up your balance sheet. You use the information available. So let's set it up. So the name of the company is Printco. So you design your SPL. Please write the full thing, okay? SPL and OCI for the year ended. 30th June 2012. Please don't go and write SPL and OCI. You are supposed to write the full thing, statement of profit and loss and other comprehensive income. Write the full thing. All right. From IAS 1 or IFRS 18, depending on the time you are doing this, we all know you start with revenue, then cost of sales. You will get gross profits. When you get to this point, leave 2 lines and come and do your expenses. The expenses, you have admin. You also have distribution. In FR, there are only 3 categorization of expenses. The next one is research. I didn't see it in the question, but I'm writing it anyway. Research expense, which come from IAS 38. Once you get this, you get your operating profit, what we call profit before interest and tax. Operating profit. Then you add finance income. And you less what? Finance cost. Memorize this thing. I'm doing it even without. You can do it without reading the question. You have to set it up because you are doing P&L. After that, you get profit before tax. Then you tax. So you have profits after tax. Then if there is OCI in the question, so you say OCI, then you bring in revaluation surplus. At your level, that's the only thing that they will do. If there is deferred tax on revaluation surplus, then you total it. This is it. So that's all. All right. So this is how you set it up. Now, from the statement, we can also do our SOFP as at 30th June. So you are supposed to do this thing without even reading much of the question, like everything. So we all know that it will have PP. So you do PP. Go through it. After PP, do you have any other form of asset? If you don't, still leave 2 lines because anything can happen. You can even make a mistake and cancel something. Come to your CA. My space is too much. Your own is to leave 2 lines. 2 lines. All right. I know you start with inventory, right? From inventory, trade, receivables. From that, cash and bank. So cash and bank or cash at bank in this question. I'm done. I leave 2 lines. If there is any other thing like the NCA for held for sale, I'll bring it in there. Then I go to my equity. My equity, I have equity shares. It's at 1 Ghana cedi. I have other component equity, which was the share premium. Then I have retained earnings. Leave 2 lines because you may face something like revaluation surplus. Then come to your NCL. The NCL, what do you have? You have loan notes, bank loan, repayable in 2015. So you have bank loan. Leave 2 spaces. There can be something else like the fair tax or something. Come to your CL. We know CL start with trade payables. All right. So you set it up. And current tax. The current asset, it can even be an asset. So maybe it will come here, depending on what it will be. All right. So you just set up the template. Now, my people, after you set up the template, there are certain things the note doesn't cover. The notes, you won't do any adjustment. There are certain things in it. You won't be doing any adjustment. So those ones, please go and do those ones quickly. I mean, if only you can spot those ones, go and do it quickly. Now, if I ask you, is there a note on revenue? There's anything affecting revenue? You didn't read any, and usually some exam question will help you. They'll put a note on them. So you know that there are some notes on them. But when we were reading, did you see anything concerning revenue? No. So your revenue,
No.
pick it straight. Don't hesitate and write fast. You know how your exams is and the time. Straight. Your cost of sales should be your last workings. So don't touch it. Did you see anything affecting distributing expenses, admin expenses? Yeah, I think admin, I saw one.
Yes.
Yeah, there was this one, note 3, admin. What about distribution? They didn't say anything about distribution. So what is the distribution figure? 7,200. There is nothing like research expense in this question, so fine. So from there, I will get my operating. Finance cost. Is there anything about finance cost? I think so, because we read something that was about interest around this one. They said that the interest was regarded as a finance cost. You do something about it. What about investment income? Do we have investment income in the question? We don't have any investment income in the question. So you can put dash there. Finance income. Tax is something you should go and do quickly because you know your IAS 12. You know. You can do quickly. There are some of the notes you struggle, but there are some of the notes you know you can do them as quick as possible. So you go and do those ones quickly. Let's go to the balance sheet. PPE there, whether you like it or not, there will always be a workings on PPE. Do we have a workings on inventory? Like, did they do something about inventory? Where is the inventory? Inventory, this is the inventory at the end of the year. Yes, there is a note on inventory, note 2. So chalk. Chalk. Do you have a note on receivables? Trade receivables? Trade receivables. There was no note on trade receivables. So why delay? Go and copy and paste. Trade receivable is 25,010. So the time that they give you to read through your questions, this is what you utilize it for. This is it. Do you have a note on bank? Cash at bank? No. The only thing we have was the bank loan. So quickly, cash at bank, 4,700. Now, if you do this and they say stop work, you know you can get some ticks. Can get some ticks. All right. So as for the equity, yeah, because they saw they did the issue of shares and all those things. So you pause here and now start going and do your workings one by one. When you get the workings, don't finish all workings before you come. Immediately you do one of the workings, you go and do. Now, your workings, the last one you do should be your cost of sales. So you pick the notes one by one and you address the workings one by one. So that's how you approach this part of your work. All right. So that is that. Now, let's start workings 1. So every workings is for a note 1. So workings 1 for note 1. That's how you work it. Right. Now, they say that on January, he raised some funds and all the thing was recorded in the bank loan. So right there, you know that this 30,000, your bank loan, should be reduced by some of them, because actually 16 million is the bank loan, and the 14 is by issue of shares. So you know that according to the question, they said that they calculated the interest of 5% on the entire 30 million. So that's what they did. Now, if you do interest on the entire 30 million, how much do you get? Remember, this thing is half year, January. Our year ends in June. Be careful. So the loan that they did, do 5%, 6/12 of the 30,000. But the correct one they should have done was supposed to be 5%, 6/12 of how much? Of the 16,000. Because the loan has a breakdown. So look at what they did and look at the adjustments you need to make quickly.
0.75 million.
Oh, give it in real figures. So that's 750, eh? Because we have 0 zeros at the top.
Okay.
Yeah, but the correct one should be how much?
What is it? 400.
The correct one should be 400.
Mm.
So if the correct one should be 400, then it means they overdid the loan by 350. So that is the interest. They overcalculated the interest by that 350. And according to the question, according to the question, look at it. The interest is payable 5% per annum, and an accrual of 6 months has been included in trade and all these things that they did, the accrual that they've done, they've also put it in the trade payables, and they use the wrong figure with that. So it means that 350 difference, the correction. Oh, my marker, my pen, Wow. Yeah. This 350 correction, we need to go and reduce the loan interest. So we are supposed to, a loan interest is an expense. We are supposed to credit it with loan interest. And we are also supposed to debit our payable to reduce our payable by this 350. Now, immediately you do this. Don't wait. Go and do it straight. So if you pick the finance cost here, 750. Finance cost 750. You are supposed to subtract 350. It will take you to the correct one they were supposed to do, which was 400. So you've done that. Then quickly go to your trade payables too. How much is trade payables? Yeah. 4170, and also subtract the 350 from it. You are done. This is it. So every line you do the correction, you just go there and you do it. As simple as that. As simple as that. So the 14 that is left is supposed to go to your, and they said that thing was from an issue of 7 million shares at 1 Ghana cedis. So 7 million at 1 Ghana cedis. What is the value of their shares already? The company, what is the value of their shares? And I'll show you that there can be share premium from all these things. All right, so this is it. So go to where is it? this one. Their shares is what do you call it? 1 Ghana cedis. Now, if their shares is 1 Ghana cedis, then it means that the 40 million, which they also issued at 1 Ghana cedi, there is a share premium component in there, because anything above that 1 Ghana cedi you see there is a share premium. Look at it. They also issue 1 million. So it means it is a 7 million shares they issue. So how did 7 million at 1 Ghana cedi now turn into 40 million? It means that the shares that they issue, they probably did it at 2 cedis. So there is a share premium on top of it. So where is our workings? Good. This one. So if it is 7 million shares they issued and the nominal value is 1 Ghana cedi, it will give you 7,000 to be added to your stated capital. 7,000 added to your stated capital. But the people had 14,000. So it means that the excess, which is an additional 7,000, will go to your share premium. Anything above the nominal goes to the share premium. So it means in our share premium, we will go there in a balance sheet. The share premium aspect, there is a share premium of 7,000. And in our stated capital too, there is another 7,000. So you will be adding these things to your stated capital. So quickly, straight, you don't wait. Stated capital, whatever is there, they did an issue of shares. Add 7,000. Check OCE share premium, add 7,000. And that is exactly why they put this one into brackets, share premium, meaning because there was something. When we say premium, premium is on top of the normal thing. If you go to a bank and you queue, there are some people who come and park their VA, they won't queue. If you get angry at the security man and you go, the security man will tell you that the manager says this one is a premium client. So that's what they will say. So what you will do is that this 7,000 to stated capital, this one share premium, the total of 14,000 should be taken out of this bank loan thing. So credit, and debit your bank loan. 14,000. So don't waste time. Straight. Each one you see, you go. It looks as if this one doesn't have anything to do with the P&L, that side. So equity shares, what do you have? 29,600. So you will add the 7,000. Share premium, you have 15,500 plus 7,000. All right. So you can get that figure. Retained earnings already is the beginning one is 11,470. So we will find our profit and come and add to that. All right. So close these ones quickly. Let's fix in the figures. What is the bank loan? Bank loan 30,000. We know that not all this 30,000 was actually a bank loan. It was only 16,000. So as for that one, I have it. So get me the figures for the other ones. And that is how you start filling in the gaps. So when your note 1 is done, fill in the gaps. So when you add this one, is it what? What do you have? Is it plus 7? So that will be 37,600, right? This one 2 plus 7 is 22,500.
36,600. For the
Which
equity.
one are you giving me? Ah, okay. Yeah.
Please, the equity.
It's 36, not 37, eh?
Yes, please.
Yes.
Thank you.
You're welcome.
All right. So this is it.
Wait.
Yeah. So that is it. Note 1 is gone. You go to note 2, which talks about the inventories. So go to note 2 and also deal with the inventory. Immediately you finish with that, just come and affect the inventory and move on. So that is what you do. All right, so let's go. Note 2, workings 2. Now, what do we have? We are told that inventories of June 20th were initially valued at a total cost of 5.7. This includes 700 units, which with the cost of 700 with the cost of 1,004. And in order to sell these items, which is the 700, they need to do additional processes of 400, at which point they can be able to sell the thing at 1,006. So we need to do the lower of cost and net realizable value. The part where there is an issue is the 700 one. That is where there is an issue. So we need to determine the cost for the 700. Now, the 700, according to this question, they said the 700 is with a cost of 1,004. So let's get it. 700 units at 1,004 per unit. What gives us, what will you get?
980,000.
980,000.
80,000.
80,000. We have 3 zeros at the top, so let's keep it at 900.
980.
All right, so that is the cost. But in order to sell it, so this is the cost. We need to find the net residual value. Net realizable value, sorry. Net realizable value is the cost, or sorry, the selling price minus any other cost you have to incur to be able to sell the thing. So they said that they will be able to sell it at 1,006. So 700 by 1,006 is how much?
1,120,000.
1,120,000. Like this. 1120.
1120.
If it is 1120, we had to incur some cost before we could be able to sell it at this one. So take away that cost, the modification, and that one will be 700 by 400, right? 400. They need to process it. So
280,000.
it's what?
280.
280. So what is the net realizable value?
840.
840. So which one will you pick? The lower of cost and interesting. Machine is misbehaving. Sometimes when I overuse it, that's what happens. So let it come. Then let's find I think given the way things are going, the lower will be the cost part, right?
The lower will be the NRE part.
Oh.
840.
840. Okay, so the lower, of course, is the net realizable value. So what is the difference? The impairment.
140.
140. All right. So it means that since this one is already in the books, according to the question, because they said that this is the one, that one is already in the books. So what we are supposed to do is to impair the inventory by 140. Impair the inventory by 140. So how do we do the double entry for this one? You reduce your inventory figure in the balance sheet by 140. Then also, when you are doing your cost of sales, inventory, opening stock, that place, you are supposed to opening stock, add purchases, and those places, which sum up to your cost of sales. You will also do it there. So please bear in mind, we will take this thing to cost of sales. Hey, COS and also inventory. This pen keeps misbehaving. So let's go to the inventory. Straight. You don't waste time. Inventory balance sheet. What did you have there before? So inventory is 6850 minus 140. What will we have?
6710.
Please come again.
6710.
6710.
Yes, please.
All right. So you can also make reference to the examiner, all right, that you will use the workings number. So instead of referencing it like this, you can go and use the that particular one. All right. So that is that. 6710. All right. That's it. Okay, so let's go to the next one, the next note. So in the next note, it also talks about, hey, I think that one too is inventory. Oh, all right. So then we will see. It says that they entered into a contract to buy electrical components over the next 3 years, but we said we will use one-ross contract to deal with that particular one. All right. So we don't have any on-ross, one-ross, but we will see. Maybe we will chip it inside. Well, if it is for inventory, we'll put it under inventory. If it is not, then put it under a different part. All right. So now, this one says that at June 2012, they purchased at June 2012, Printco has a contract to purchase 22,500. Hold on. What did we do? Did we touch this value? Inventories at the end. Inventories at the end had the cost of this. Then which one was that? Hold on, let me see something. Inventory on 30th June. Oh, this is opening inventory, guys. This is July 2011. This is June. Right? So
Yes.
please, then let's correct this thing.
Yeah.
So the end one is 5,700. Closing inventory. Opening inventory, we will use it for cost of sales, that thing. Opening stock, add purchases. So instead of opening stock, we will do opening stock. Instead of add purchases, we will add production costs. Okay, so correct it for me. Let me see. At 30th June 2012, Printco has a contract to purchase 22,500 electrical components over the next 3 years at a cost of 22,450. So let's do the multiplication. We will do the multiplication. Have you gotten this figure for me?
It's 5560.
5560.
60.
This thing is interesting. You are, please, then it means when you are also doing it, be mindful of the dates, okay? When
Okay.
you are doing it, when you are doing the exams, also be careful of dates. All right. So multiply, let's do our next workings. Workings 3. The workings 3, the thing is 450, they are 22. So the price of the contract is 22,500 by 450 each. Okay. And he's supposed to do that over 3 years. So if it is over 3 years, it means we need to capture only 1 year. Yeah. Because in P&L, one thing you should know is that the P&L talks about only thing that is 1 year, not more than 1 year. But even in this one, it looks as if the contract is done on 30th June. That's the end of the year. All right. Then it says that the purchases are made at a constant rate. So it means looking at this, the purchases are going to start next year because this contract is done at the last day of our year. These components are no longer required for their initial purpose. Even if we buy, we are buying waste. So, which will require an additional manufacturing cost of 600 per component. So, another cost. So, 600. Thereafter, each component can be sold for 900. So, get me the total cost and let's look at the net realizable value. The net realizable value, which is 22,500. They can now be sold for 900 each. All right, get me the total. Let's compare. I'm sure this one too, we will have a loss in there. The lower will be the net realizable value by all means. Alternatively, he could cancel the contract for 4 million. So let's find the difference.
The first one is 10125.
The second one is 13500.
13500.
00. The
Total.
total is 23625.
That is the cost. How much it will cost you. What about the net realizable value? 10,500 multiplied by 900.
250.
20.
250.
250.
So this is what it means. If you go ahead to produce the thing, you can only sell it for 2250, which means you will lose. There is a loss of how much? That's the impairment. How much is that? If you go ahead to produce everything,
3375.
yeah, 3375 is a loss. That's what it is going to cost you. But if you say you don't want to fulfill the contract and you want to go in and incur a penalty, the penalty is 4 million. So what would you do as a business? Will you pay the penalty or you just go ahead to do the contract and do it and make the loss?
You continue to make the
I'll
loss.
do the contract.
You do the contract. So it means that the 4 million will become useless. So what this thing will happen is that, remember, it is a loss you are making. And this loss is happening the next year. It is not within your current year. is happening the next year. So that means that what the double entry will be to separate this thing. 1/3 will be current, because what is in front of you, just the 12 months in front of you, is current. And 2/3 of the money will be non-current. And these are non-current and current losses, which should sit in your, what do you call it? Your liability side, because it is a liability you are going to bear. All right. So that is onerous contract. A contract that you know that right from the beginning, when you go ahead to engage it, you will make a loss. You will make a loss. So those losses are supposed to go into your, what do you call it? Your expenses. And the expense is a loss in P&L and also a loss in, what do you call it? Your liability. How would you record the loss? According to the question, it says that any adjustment resulting from this should be made in the administration expenses. So the total loss, we are providing for that loss. Even though the loss is in future, you need to provide for it now. So the provision should be made between admin and your liability. And the provision that you are going to make in the admin is not, it's the entire provision, this entire 335. And you also put it in your liability. But the liability, to score more points, know that the 12 months ahead of you is what we call current. Then anything 24 months going is non-current. So split this figure, but in our admin, we need to go and add it to our admin expenses. It's a loss that we are incurring. So the admin one, the information that you have about it, how much was our admin before? 7,200. Or let me see.
29,750.
29, sorry. 29,570 plus 3,375. So that is the admin. And we'll also add it to the CL and NCL. So please give me the figure for the admin. Add it and let's write it. And let's go and also affect our CL.
32.
It's what?
32945.
32945. That is that.
Confirmed.
All right. So now we need to go and do the liability part. So 1/3. So let's say onerous contracts. So the spaces I told you to leave. It is 3,375. 2/3 will go to NCL. Then another one, onerous contracts. So if the penalty would have been lesser, we will use the penalty as the provision. All right. So the 1/3 of 3,375.
1125.
Which one? Is it the 1/3?
The 1/3, yes. Please.
It's what?
1125.
1125. All right. Then the 2/3.
2250.
2250. All right. So that note is done. That note is done. Then note 4, on July 1, that's the beginning of the year, they decided to sell a piece of land. So this one is taking us to our PPE workings. So they decided to sell a piece of land. And this one is the one that we said is the held for sale, right? They classify it as held for sale. But do you know the recognition criteria for held for sale? The asset to be available for sale in its immediate condition, right?
Yes.
All right. The owner should be looking for a buyer. We will do all those things with you and the CL people because the standards is the same. All right. So this one, we are classifying the thing as held for sale. And the classification of held for sale, the measurement is the lower of the carrying amount and fair value less cost to sell. Lower of carrying amount and fair value less cost to sell. So it's That is, so write it down. IFRS 5, what you need is the lower of carrying amount and fair value less cost to sell. That is what you need. So we need the carrying amounts and fair value less cost to sell. Then we will select the lower. All right. And anytime the lower is usually the fair value less cost to sell, it means there is impairment also. Because if you have learned impairment, impairment is when the carrying amount is greater than the recoverable amount. You have impairment. And recoverable amount is the greater of value in use and fair value less cost to sell. But because you are selling the thing, you can't have a value in use. Value in use is when you use it yourself. But this one you are selling. So this one automatically, less cost to sell becomes automatically the greater, which will represent your RA. And if the CA is greater than your RA, then it means there is impairment. That's the meaning. So let's find they were going to sell a piece of machine. All right. And they classified it as held for sale. The machine had a cost of 2.4. A cost of 2.4. But the carrying amount is 1.5. So you have 1.5 for carrying amount. All right. Then it says that at that date, which is the July, beginning of the year, the fair value less cost to sell is 1.14. Then machine was sold for 1.1 after the selling cost. So it means that the fair value is 1.14. And after the selling, so the selling will be the 400. Is that not it? Because if something is 1.14 and you sold it for 1.1, that is the fair value less cost to sell is 1.1. That is it. The fair value less cost to sell. All right. That's the meaning. It means the thing 1.14, no? You had to incur 4 to sell it. So you had only 1.14, 1.1. So clearly there is impairment because the CA is greater than the FA. Impairment of how much is that? That's the 400. 400. What do you do with the impairment? Impairment, where did he tell us to do the impairment? No adjustment has been made. The question didn't tell us where to put the impairment. So we can add it to cost of sales. All right. Can add it to cost of sales. And the value of the fair value, the assets, NCA held for sale, by the one that will go to our balance sheet will be this one, the fair value less cost to sell. That is what will be in our financial statement. So if you go to the balance sheet, you should have another asset called NCA held for sale, and this is the value, which means that that machine should not be part of our PPE anymore because we are taking it to classify it as held for sale. So this 1,004 will go to our balance sheet, and this 400 has to be in our P&L. All right, so that is that. That is that. Because the 1,001, this asset, this whole asset, we are going to take it away from our machinery. And because we are taking it away from our machinery, the double entry, this one will go to P&L, then the 1,004 will go to the balance sheet. But we will take that the together, which is the 1,005, to make the double entry complete. We will take it out from our asset because the asset is no longer being in use. We are classifying it as held for sale. So in our our P&L, we need a place to put in. So let's put it as part of cost of sales. But in the assets, current asset, that's where IAS 1 say we should put it. NCA held for sale. So we will put it there. NCA held for sale. This pen is misbehaving. 1,001. Have you seen the impact of the standards on your publication now? It's deadly. It's very deadly. But we will have time for those things. We have time for those things. So, all right. Which working are we left to do now? We are done. Don't forget, I've told you that the last working you should do is the cost of sales. And we have had two things we will push to cost of sales now. All right. So the next workings 5. Print co decides to depreciate. So that means we need to do our PPE now. So how many assets do we have? We have plant and machinery and land. So land, plant and machinery. All right. What is the cost of the land? But anyway, in the exams, you don't need to be writing cost. Just go ahead and do it. So land is
45,000.
then P&M.
16,200.
16,200.
Then 200. Then depreciation.
Accum dip.
7,290
For this one.
for P&M.
But remember, the P&M, the one that we are holding for sale should leave. Okay, it should not be part of, because that thing was machinery. So we need to take that one out. It can't be part of our machines anymore.
Okay.
Because if we are holding it for sale, it can't be there. All right. So once you have 16,200, you should take away that one too. All right.
Okay.
With its accumulated depreciation, it should go. So take note of that. So we need to subtract that one too. NCA, because let's even do that. Well, it's presentation. At the end of the day, you have the same answer. NCA held for sale. Oh. This pen too. So what is the value of the assets that we are holding for sale? Let's go back to our NCA for sale. We even had it here. 1,005, right? That's it. No, the cost is 2,400. So this is the cost. This side is cost. That side is cost. And the accum date should also leave. The accum date, you find it. But at the end of the day, I think it's the same thing. When you put in 1,005, it's the same thing. You use the carrying amount, it's the same thing. Because if you put the cost, you also do the carrying amount, the net realizable, what do you call it, the accumulated depreciation for that particular one too. So at the end of the day, you still get your 1,005. So that's fine. So subtract 1,005. Let's go. So let's have our pure balances for the depreciation calculation. Get me the pure balance for depreciation calculation.
Seven for 10 for the P&M.
For the P&M, 7
for 10.
Oh no. Okay. This was a subtraction. I hope you did that.
Yes, please.
Good. So what is the depreciation policy? 15% per annum. So how will you do your 15%? Now that the 15% is on cost, right? Because that is it. The policy is 15% per annum. So what is the cost? That is the reason why probably we should have deducted the 2,400 rather than. So this cost, there is a 2,400 inside it. So we could have subtracted the 2,400 and also do the accumulated depreciation for that 2,400 down. But we all know that there is a cost of 2,400 that we have classified held for sale. So deduct that 2,400, the remaining, apply the 15%. So that will be 15% on 16,200 minus this cost, 2,400. And let's get the depreciation for the year.
2070.
It's what?
2070.
2070. So what will you have for carrying amounts? This is 45,000.
5340.
94.8. Hey, sorry.
Confusion is basa. What is the figure?
5340.
5340.
40.
So we have our PPE now. So add it. Then let's go and do this one to our depreciation. So depreciation 2 is supposed to be added to cost of sales. Now we can do our cost of sales in piece.
50,340.
So let's go to balance sheet PP 50,340. So can you add the asset for us so that we will know our balancing figure? So you will reference the workings, okay? So workings number 5 was this. So let's find the total of our assets. Then we'll go and do our cost of sales. And I think that will be all. Cost of sales and tax. We will do the tax first. And we will do cost of sales as our last working. So now we have a depreciation. We have the one impairment from held for sale. And we also had another impairment. I think we had another inventory. Yeah, this one.
$86,710.
86,710.
710.
All right, so that's fine. Okay, so let's learn our tax now. Tax. CTDT. I don't think, did we have DT in this one? So the income tax for the year is a refund. So tax estimate is a refund. So you put it in brackets. It's a refund. 2530. It's a refund. So unlike the other one you've been doing every time, you have to be careful. It is a refund. You have to be careful. All right. So estimate for the year is an income tax refund, which means the business is supposed to now be the one receiving, not the one paying. So take note of that. So if it is a refund, then it means when it was not a refund, I said you will take it where?
Current liability.
But now that is a refund, you will take it where?
Current asset.
Current assets. So the space I told you to leave. Hey, and we are coming to total. Okay, hold on. No. See. So add the 2530 to the answer. I'm coming to delete it. Oh, so even my space is exhausted. So you have this figure 86,710, right?
Yes, please. 89240.
So the total will be what? 89,240.
9240.
Okay, and this is 2530. That is current tax assets. All right, so this is the one that we rather have. Let's continue the tax. Is there under or over provision in the trial balance? Under or over provision, any tax? Is there tax? Tax is not in the trial balance. So if tax is not in there is no tax in the trial balance. Under over will be 0. Movement to is 0. So it means this negative should also go to the P&L. And please, it is not an expense. It is a negative. So it should be an income. So instead of taxing negative, now we are taxing positive. What is the tax in the P&L already? Do you have tax already? We don't have tax already. So if we don't have, is put in your negative. So instead of subtraction, now since it's negative, it will be addition. It's an income. It's a tax refund. GRA is giving it to you. You are not the one paying. So it's an income. All right. So now the only thing you will be left with is cost of sales, right? Cost of sales. So let's go and do the cost of sales. That's how you work it. And everything will flow from there. So COS. How do you do it? Opening stock, right? We had opening stock. The one that I nearly made the closing. 68,500. Add purchases. But here we won't add purchases because this company is a manufacturing cost. So add purchases, they produce themselves. Production cost is 60,150. Then we now need to do the depreciation that is coming to cost of sales. How much is the depreciation? 2070. 2070. Then there was another thing that we said will go to cost of sales. Held for sale, 400. 400. Then I think it's left with another one. The inventory notes that we did. Which workings was that? Workings 2, eh? There is an impairment of 140. We have to add 140. So this one, the closing stock, that was 55. So we will less closing stock. Okay, so basically that is that. That is that. So this is the closing stock figure that we have. So you add 140 and you will less your closing stock figure, your closing stock. This one, or you can decide to less the adjusted one straight. That's what you can. You can decide to less the adjusted one. The adjusted one we had, that was a 5560. That's what we had, right? So you can decide to add 140 and less the entire 5,700, or you can decide to do the adjusted one straight. Where is it again, Impo? This particular one, the one that I nearly made a mistake. All right, I think I can't find it. So We have 140. So add it up. So this is it. Then the closing stock, you less closing stock. That is 5,700. Now, if you take these two, you can just go straight with 5560. It's the same thing. So what is the closing stock? So closing stock impairment. So these two. So what will be your closing stock? Sometimes the examiner will give you the cost of sales. So all you need to do is to be adding these impairment adjustments. That's all. That's all. So take note of that. So finish it. Let's just add the figures and go.
63910.
It's what?
63910.
63910. So that's our cost of sales. 6391.
Confirm.
So now put it in here, 63910, and let's find all the missing figures. 63910. So what will be our gross profit? This is 97.
33490.
33490. All right, go on. Let's find operating profits.
A loss of 6655.
6655. Okay. Okay. That's why they made a tax gain. All right. So that is, what makes it then? Plus 400. Another negative
A
4.
loss of, yes, 7055.
7055. Subtract tax gain.
A loss of 4525.
4525.
25.
So that's also a loss. All right. So the balance sheet, retained earnings is a loss of minus 4525. Now add it up. Let's see if it will balance. So current tax was the same. The tax here. We won't have this one because it was a tax asset. Okay.
It is the return earnings is 6945.
8945.
69.
69. Okay. 6945.
Yes.
All right. So total your equity.
Total equity.
Mm-hmm.
66045.
Confirm.
66045. Then let's go and do all the liabilities. I think we have this one, but get me the figure here.
3820.
3820. Okay, so total all your liabilities.
23195.
23195.
95.
So let's add it to the equity and see if we can get our 89240.
89240.
89240. Good. Then
Okay.
that's it. All right. So this is it. This is it. All right. So that ends this section of the publication.